Good morning. We're opening the Deferred Compensation Advisory Committee for Thursday, August the 27th. It is currently 10:03 a.m. and we'll start with the roll call.
Before we jump into roll call, I just wanted to quickly name that we do have 2 administrative support shifts in responsibilities. So we're going to ask that we bear with our team as we move through this process, because this will be their first time participating in the administrative support of this.
Hi, good morning, everyone. With roll call, I'm going to call Robert Bonner.
Present.
Sandy Regalo.
Here.
Fonse Kyokum.
Present.
Jeff Wolkamp. Absent. Greg Frank.
Here.
Supervisor Dollywall. Absent. Don Narayan.
Here.
And going to online, can you please introduce yourself?
Good morning, John Stagel, Executive Relationship Manager with Nationwide.
Thank you. And for the rest of the room, can you please introduce yourself, starting with?
Sure. Good morning. This is Brendan DeVecchio with Nationwide Deferred Compensation Plan.
Vincent Galindo, consultant with FCG.
Oriana Mahoney, Benefits and Development Manager for San Joaquin County.
Christine Vega, Personnel Analyst for the Benefits Office.
Jansel Johnson, Human Resources Office Technician Coordinator.
Kimberly Johnson, Assistant County Counsel.
Okay, and that is it for roll call. Thank you.
All right, with that, make a motion to approve the minutes from the May 28th, 2026 meeting.
I make a motion to approve the minutes. This is Fonse, I'll second.
Motion approved. Oh, we take. All those in favor?
Aye.
Aye.
Since I was absent, do I have to abstain? I thought so.
Motion passes.
And then we're going to move to public comment. I did not see any public comment online. Is there anyone in the room that would like to make a public comment? No public comment.
We'll pass it off to John Stagel for the program status report.
Thank you and good morning. I'll share my screen and I see you have printouts in front of you. So, all right, so we'll go and jump right in. Appreciate the opportunity to present an update for the second quarter. So we'll have comments from both myself as well as Brenda, who is there with you. So we're going to start, just expand this here. Can you all see this okay? I know that you have your hand out.
Yes.
Excellent. So we'll start on page 2. The page numbers are on the lower right. And this is just the balance sheet. So the top row is where the quarter started. So that was on April 1st. And then we have activity throughout the quarter. So you can see contributions in, money out, and we'll talk a little bit about each of these rows here subsequently throughout the report. Then we subtract fees and loans, and then you can see the market gain for the quarter was up 56 million. So your plan started at around 661 million on April 1st. It finished the quarter on June 30th at roughly 717 million. So really nice growth in the quarter. So very, very pleased with what we're seeing. We'll jump into the next page. Just real briefly, since we're going to cover most of these items, I just wanted to highlight on the right side of the new account number for the quarter. So Brenda had 167 enrollments for that period of 3 months. So excellent number. It's a positive 25 change from the first quarter, which was also impressive at 142. And so she's enrolled over 300 participants year to date, at least for the first 6 months. So really nice job to Brenda getting as many of your employees signed up in the deferred comp plan as she can. On the left-hand side, just shows your total participants with the balance. So we are over 8,000 there. And we'll jump to the next page, which we'll talk about this again. So the upper left, again, we have our participant count. We have our average account balance of just under 90,000. It's a positive change of 6,000 from the quarter prior, again, due to market growth in the second quarter. The other things to point out that we look at every quarter, plan assets by employment status. So 53% of the assets in your plan are held by participants who are currently still working for the county. About 45% of the assets are held by participants who are no longer working. So it's almost a 50-50 split. And then we show Roth usage. We'll talk about Roth on the next page, but we have a summary of Roth usage and also Pro Account. So we added Pro Account recently. We have 2 participants who have enrolled in that service, and most likely they're starting from a zero balance. So we have $1,000 of assets in Pro Account. So we'll continue reporting on Pro Account usage each quarter as well, since that statistic is shown.
Can I pause you right there? The Pro account was, remind me, that was something that we voted on the last time, right? To add as an option for employees who were interested in that particular account?
That's correct. It's an optional service that helps your participants invest. And that was added last quarter. And so it's a brand new service that is offered. Jump into the next page, page 5. So optional strategies. We again look at Roth up in the middle of the page, kind of on the left to the middle. You can see the average Roth balance in your plan. Your participants have the election to invest in pre-tax or after-tax. And so you have $18 million in Roth dollars. So we record keep those separately since Roth money is tax-free. So your average balance is $10,690 and growing. We have 1,684 participants who have elected to invest in after-tax money. The rest are in pre-tax. And then below that, we have the SDBA is self-directed brokerage account. So that is through Charles Schwab. Nationwide partners with Schwab to offer a self-directed option to those participants who want to invest outside of the core investments in your plan. I do have the Schwab report. Just a quick update on that is most of the assets are in ETFs and mutual funds. The mutual funds that they're purchasing are typically commodities and gold and tech. So investing in things differently outside of the core options. We'll take a quick look at money in on page 6. So the next page, right in the middle of the page, we have the current period next to the prior period. So Nationwide received $11.9 million in contributions in the second quarter. Most of that in the form of salary contributions. So 8.7 out of the 11.9 were payroll deducted salary contributions. We also have some other types of money in as well. But again, most of it, like most plans in most quarters, comes from payroll deduction. And the wheel shows the percent of asset classes. Well, it's the percent of contributions put in each asset class in the quarter. And so the largest percentage is categorized on top. So we have 54% of all new contributions that Nationwide receives are going to what we call asset allocation. Those are your target date funds in the lineup. So over half of all new money is being directed to a target date fund. And then second is large cap mutual funds are receiving about 17.8% of all new contributions. Third being fixed. So the Nationwide fixed fund is about 11% of new contributions. And then the rest of the asset classes are not being utilized as much. So really the top three make up almost all of the asset classes for at least new money that's going in and flowing into Nationwide. Money out, so similar story here. So money out current period, 12.2 went out the door, about 5.2 of that in rollovers out, 3.2 in what we categorize as retirement, but this is also the same thing as distributions or receiving cash. So this makes up about 8.5 million out of the 12 million. And then the rest are the other various forms of distributions that your participants can take advantage of when they have left service from the county. So rollovers are up slightly. Retirement's about the same as last quarter. We had some account splits, so those are divorces when money is separated out. So that is why I think there was the largest gain in money out for the quarter. You can see it 2.2 million versus just under 300,000. So if we didn't have those account splits, your plan would have been cash flow positive for the second quarter. So not too concerned there. So we're not going to see, I don't think, a trend like that again. So in the current period, there were 14 of those. So you did suffer a little bit there by account splits, but generally speaking, your plan's in good shape. So we looked at where new money is going. Here is where your existing money is sitting in your plan. So on the upper left, we have the asset allocation in your plan. You can see the very top line is asset allocation. Again, target dates represent around 26% of the total assets in the county's deferred comp plan. Bonds only make up about 4.7%, fixed about just under 19%, large cap about 36% of your assets. Then the rest are invested in mid, small, and specialty. So I won't spend a lot of time there, as you'll see the same with the FCG report. And the next couple of pages are just all of your investment options in the plan categorized by assets. So on the next page, under fund balances and utilization, the investment with the most assets is on top. So we have the fixed account or the Nationwide fixed fund, followed by the Vanguard Institutional Index, the T-Row large cap, then a Vanguard equity income, then a series of target date funds ranging from 2025 to 2045. So those are the most common. These are based on the retirement age at 65, so we can kind of tell who's investing in these by date of birth here. But those are your top holdings, so I won't spend a lot of time going through those. Just wanted to point out at least the top few that have the lion's share of the assets in your plan. So moving on to loans, we'll just take a real quick look at loans. On the upper left, we have your active loan balance currently through the end of June is 4.3 million in outstanding loans. Those loans will be paid back at some point by your participants. There's 414 open loans currently. We opened 60 last quarter and closed 28. So loan activity has increased a little bit there at the county. The prior period, we opened 42 loans, closed 39 loans. So each quarter looks like people are taking more loans than closing. So again, your average loan balance in the upper right is not growing much. So it's 10,004-ish. So that's a good sign. So your participants are not taking a lot of money when they borrow. They could borrow up to half of their balance, up to 50,000. So it's only about 20% of the total that they could take. But we are seeing a trend in increased loan activity. Any questions or comments? I know I'm going kind of quick.
I have a question. A couple questions in regards to the Roth. If someone qualifies to actually contribute to it, where would they find the information at? Would they go to HR, or would they go to Nationwide?
Depends on the question. Are you asking about
how would they open up an account?
The difference?
How would they open up an account? A Roth account?
Do you want me to take that, John?
Sure.
So the post-tax savings option is embedded in the 457 plan. So during the enrollment, like if they're doing an online enrollment, we give them the choice. They can say pre-tax or post-tax. If they start pre-tax with their enrollment and they go in to make a contribution change, they see both options. And so they can then at any point in the future, if they don't start out with a post-tax or Roth savings option, they can always add it and integrate it later on down the road. But we have that, we kind of show it during the enrollment, and then we also offer it during the contribution change or update phase. On your website, on the county's custom website, we also offer a search engine. So if somebody types in Roth, they'll get more information there. And of course, conversations with me are always good.
Okay. And the second question, with regards to the catch-up, if someone were to max out on their 457 contributions and the $8,000 catch-up, does it automatically go into the Roth, or do they need to do something different to get that started?
Okay, so I think what you're asking about is the new high wage earner, the new Rothification rule. So for employees that make over 150, who made over 150,000 last year in Social Security wages, the IRS has imposed a new rule that basically says if you made X number of dollars last year in Social Security wages, moving forward, they change the way we can save. So the first 24,500 can be all pre-tax. The county has opted to let it be active choice. So the county's payroll system has done a good job sharing salary information with us, so we can also help them monitor for the new rule. But they will stop the contribution at the first limit. And then if people want to take advantage and save the extra, whether it's 8,000 because you're age 50 plus, or if it's 11,250 because you're age 60 to 63, the county payroll will open that up and let them save in the post-tax basis or Roth, which is now part of that new Secure 2.0 legislation. Does that make sense?
It does. And then the Roth, could the Roth be a self-directed fund, or is it?
Sure.
Okay, perfect.
Yeah.
Thank you. That's all I
Yeah,
have.
good questions.
One thing I just wanted to quickly note about your first question was, we don't do any of the signups for any of that through HR. It would all be through Nationwide. And when Brenda was referring to the county web page, what she means is the Nationwide dedicated page to San Joaquin County. I just wanted to make that clear.
And then back to your first question, you had proceeded with if you qualify. I think a lot of times it's common that one misconstrues the Roth IRA, which has salary limitations, to the Roth 457, which don't. And so really, in a way, and you're good explaining this, everyone qualifies within the 457, not necessarily the IRA.
Well said. Thank you, Brendan. Thank you, Vincent. Any other questions about Roth? It's a good topic. It's a popular topic. We catch up as well. And okay. So just wanted to point out on the next page, and I'm almost wrapped up, under enablement and engagement. When we first started working with the county under beneficiaries, I think it was in the 40%. So we've done a really, really good job of getting as many beneficiaries on file as we can. We're up to almost 90%. It's not perfect, but it's really good, and we're very pleased with that result. So again, just wanted to point that out as something that we've been talking about over the years that we wanted to improve, and we're definitely showing areas of improvement there with beneficiaries, since your prior record keeper didn't send that many over. And so we've had to kind of start from the beginning to work on beneficiary numbers and make sure that everyone has one on file. So emails, really good, 94%. And then the rest of the stats are also very solid. I'm going to pivot there. I know I talked a little bit about self-directed, and this isn't our report. I don't want to spend too much time on this either. Give me 1 second. Oops. 1 second here. So just wanted to show the Schwab information. I think it's interesting. So let me move this out of the way. Okay. So there's 13.3 million, and you can see the average age 63. There's a high average balance, like most plans in Schwab. It's 179,000 compared to the average balance in your plan, which is just a tick under 90,000. So most plans I work with, all large custom plans, mainly in California, the Schwab balance is typically double what the average balance in the plan is. And so when your participants enroll in self-directed, this is what they're purchasing. And so there's only $4. Income, so they're purchasing fixed income. That's the largest share. The mutual funds is the largest share. And when they're buying mutual funds, you can see, I mentioned earlier that they're looking at precious metals, commodities, gold, and so forth, a short fund, a tech fund. And then there's just a little bit of money in equities. And then these are the ETFs that they're purchasing. So interesting to see what San Joaquin County employees are putting money in outside of the plan. So I'll pause, see if there's any other questions about any of the nationwide statistics. But overall, I would say that your plan is looking really good, really nice market gains, nice enrollment numbers, good diversification. So all positive numbers. So we're excited for, to what we've seen. So I'm going to pass it over to Brenda. She'll give an update on what's happening there locally. And then we also have an agenda topic around the retirement age.
All right, thank you, John. So, field update. I've been busy. Yesterday I was at the sheriff's office, and that was a fun, busy day. Just some feedback that I've been getting out in the field and let you know what's happening with the education that we offer. You might have seen our IT department sent out our most recent group of classes. We do some team webinars. We do those quarterly, and we put them in QR code form. So if any of you didn't get a chance, I have one here with us, and if you want to sign up for any of the classes, that's a good thing. For Q2, which is kind of what we're focusing on, we haven't had an average of about 7 people per class. So I would say that's definitely lower than average attendance for the education that we offer. We did a class for enrolling, basically learning about the deferred compensation plan. And for the one that we did on the 25th, most recently, we had 19 people. So I'm really encouraged to see the increase in interest. The county did a good job, I think, getting that information out to the employees. And we really appreciate your partnership on that. As we continue to offer these quarterly classes, I feel like the more people know about the benefit, the better use they can make out of it. I'm also excited to say I've been working to get on site at the the EDD office out north. And it's taken me a while, but I've got a date coming up for the 2nd. And I'm really looking forward to the opportunity to kind of just expanding my presence in the county, visiting a site that I haven't been to yet. So I'm very excited about that. I met with a retiree here the last time I was here, and I have another retiree who's going to meet me out north. And they were very excited about these classes. As a matter of fact, one of the retirees that I met with is still very active on a lot of committees. So I gave him one of these to share with our retirees, because we do have a specific class happening on September 10th that is targeted for retiree benefit. This is a lifetime benefit for all employees. I still have my old 457 plan at the Office of Ed and have really enjoyed that benefit since I enrolled. So we do want to let retirees know what type of benefit is available to them and how to still really take advantage of what we offer in those golden years. So that's pretty much it for my field report, but I do have a couple of topics I want to share. The first one is just a call that I got yesterday morning from a retiree who's back, and she's done a really good job saving. She's got like 2.4 million in her account. She has over 1 million in the Schwab self-directed brokerage account. And the reason for her call to me yesterday was because she wanted to start an annuity. So that's a topic that we talked about last year, and the county was considering adding it, but then after further discussion, they put that on the back burner. But I just want to let you know, your high balance employees are looking for products that give them guaranteed income and some security in the future. So just want to give you a heads up that those types of products are still being requested and searched for as part of the deferred compensation plan. So I know based on our conversations, you're aware that Nationwide does offer those products. I know John can share with us, we have several large employers who've sort of added this as just part of their basic menu. So that's always available if the county ever wants to revisit that. Did you want to add
Yeah.
anything, John?
Yeah, our most recent, so we just had City of Chicago add a retirement income builder paired in the last, I'd say, 4 weeks. I think they're 17 billion assets, so they're a major plan. So we're excited to see that. So there has been some growth in that product.
Yeah, and I've even added it to some of my small plans. I'm the rep for Clements Fire, which is sort of a training facility for the firefighters, but I've been working with Dave Ingram for years and years over there, and he was really excited to hear about the pension marrying product, and he's added it to their plan recently for their staff there as a way to save for retirement, because often when you're in that space, there's not a pension happening for those employees. So just want to sort of lift up that we still do have products and things that we can offer in that protected retirement space, and that your employees and retirees are still looking for those types of products. Again, the goal would be retention, because I often see people leaving, taking their dollars away from the county because they're looking for some security that annuity would offer. But of course, then they're also taking on kind of the dark side of the annuity, which is, sales charges, penalties for early withdrawal, and things like that that don't apply to the products that we offer. So just a heads up on that. The other agenda topic I wanted to talk about is the normal retirement age for public safety. So in the plan document, a lot of what we adopted just kind of came over from your old provider. We did update the normal retirement age to sort of match up with what we have at SJ Sarah. And I've been communicating with my friend Melinda de Oliveira over there just to confirm. I had a question come up from one of the employees that's been with us for a while at the Sheriff's Department. He's Tier 1 Public Safety, and he wants to take advantage of the 3-year catch-up. So that's the ability to save more in the 3 years prior to the year you retire. Your current plan document with us shows age 50 as a normal retirement age for public safety. But in my communication with the officer and also with the county pension system, they allow Tier 1 to retire with 20 years of service, regardless of age. So this gentleman is looking to retire at 46. So the way the plan document is sitting right now, it sort of excludes him from the opportunity to do that 3-year catch-up that he's very interested in doing. So I just want to sort of lift it up just as so that I'm sharing with you what I'm getting in terms of feedback from the employees, and wondering if we are interested in sort of using the nationwide standard. When I see like our basic unchanged plan documents, usually we start the normal retirement age for public safety at 40. So if we were to do something like that, or if it's something that you wanted to discuss or even consider, that would no longer exclude employees that are Tier 1 public safety from using that special 3-year catch-up. So just wanted to sort of lift up what I'm being asked for in the field, and sort of the roadblocks I'm running into, to see, what your thoughts are about that.
And just a comment too, to change a normal retirement age is very simple. We would just modify your adoption agreement and select a new date. So right now, Brenda said it's coded at 50. We could change that to 40 and turn that around for signature in about a day or two. So it's a very simple change.
Yeah.
I have 3 questions, comments.
Yeah.
Number 1, I think it sounds like you spent a little bit of time talking about the retirees. I think what may be helpful is Patrick probably already sent nationwide some dates for some of our open enrollments that are coming up.
Mhm.
We are going to have 2 of those dedicated dates where retirees are going to be able to be in attendance here at the admin building and at Mickey Grove. We're also going to be doing some outreach to the retirees. So I think that it would be helpful to make sure that you have somebody there who can speak directly to that at those particular, and have whatever literature you need for retirees. Typically, you guys don't have that for retirees because they're not usually included, but this year we're including them. So just wanted to make note of that. And then as far as the annuity products, the retirement income builder, I know that we had all had a discussion about that and decided to put a pin on that until next year, when there was a little more, when we've seen how it's how it's going for the rest of the world that's utilizing it. So we kind of wanted to just see what some of that looked like. So I know that that was something that this team decided that we wanted to give it about a year and then revisit that one. It would be helpful though, and I know that we had this discussion, and Vincent, maybe it was somebody from your team that talked about other options. So I think outside of the retirement income builder, if there's any other type of annuity products that you guys have that you could even give us some information on, I think it would be helpful for this group to get some information on other products outside of the retirement income builder. So if there's something outside of that that you guys can bring to present on next time, would probably be helpful also. And then the plan document change, what are the downsides of that? Are there any downsides to changing that document to reflect the lower age? I know, just trying to think of our MOUs, contracts, and resolutions, if there's anything that we would need to modify in our language for that based on that, or is there anything that you can see as being something that would sort of block or deter that, or yeah, so that's my, sorry.
Yeah, I would say there are no downsides. I would say there's only upsides that people want to use catch up sooner and they're prohibited from that. And it's really prohibited up to 4 or 5 years worth of contributions that are missed and market loss. So that's my opinion anyway. I mean, a lot of our plans do it. So it's definitely something that other plans take advantage of. I don't see a downside unless someone else would disagree.
My mind is generally there's always a downside. I agree. I can't think of one, and I've been racking my brain since Brenda stopped talking. So I agree.
I think the only downside is you're saving too much money at the time, but I think not spending
Right.
it on other things. But I think had Manuel used to say, "Great minds think alike," and then then there's you and I, because those are my exact same questions. I think we should bring back the annuity product probably, like you said, a year from now. And again, the downside, I don't know. I couldn't see any downside, and I would have asked that. I think we should implement that if it's just signing a document similar to what we did, moving the employer contributions over to the 401. I mean, it's been sitting there for many years. I'm surprised someone hasn't came up and said something like this. That doesn't mean an individual is going to take advantage of it, but if someone can take advantage of it, we should open it up.
So I don't know if the committee wants to put it to a vote, if that's even allowed.
It's not allowed because
have
it's
to be
not
on the next
agenda.
So maybe next time? Okay.
I do have a question. You mentioned safety unit, but what's that do for tier one on the general, for the others?
I'm sorry, say it again?
You mentioned that it was for safety,
Uh-huh.
but we have two different types of 457 flex
Yeah.
plans and age limits. So
Yes.
wouldn't we want to look at both and do that? And
I think we're
for the
good.
tier one, I thought it's 30 years, but sorry.
Yeah, so I believe we have general employees set at 52, which does match up with the SJ Sarah pension system, I think, for both tiers. I can look back at Melinda's email just to be sure as well.
Yeah, we're at 52. I have your plan document up right now. You're 52 up to 70.5. And then we have police designated separately at 50 and fire designated separately at 50.
Is that something to consider? They're looking at all of the plans and making an adjustment for all of them, not just safety in general, because we have the 3-year as well in a general, correct? And it's 30 years.
Yeah, I haven't run into any challenges for our general employees because for general employees, it does match up with what is in the paperwork, in the, what's the right word, in the tier information. So I did check with Melinda on that just to make sure that, because we did kind of like that first level for general employees because it was a little bit off. It didn't match up in the plan document that we took over. So the committee did that pretty early on. But I just recently ran into, I know, but I don't know it all. So we ran into this challenge for this employee. And so I just wanted to lift this piece back up to us for us to talk about.
I think what Dawn's referring to is if you have 30 years of service, regardless of your age, you can retire. So if someone started at 18, so their retirement age would be 48. So could they enjoy the catch-up provisions at 48 is what she's probably.
Yeah,
Thank you. That's exactly what I was.
Okay, I haven't run into any general employees asking for that. and our plan document says 52 for general, John, is that right?
Yes, that's correct.
I'm just gonna go back and check what I got from Melinda.
I think maybe a little bit more research and adding that to the next conversation anyways, as we go to take a vote would probably be helpful, so that way everybody has some time to review documents and come with the questions.
I just want to make sure that we're looking at all of them equitably, especially because I'm in the general sector and HSA 1200 of us are going to go, oh, why did safety get something that we didn't? Because I hear that all the time. So I just want to make sure I have an answer for them.
Yeah, and I do see in my response from Melinda, I guess I was really focusing on the public safety, but she does mention that general members, tier 1, can retire at any age with 30 years of service. So, you know, if that warrants a reduction on the plan document to match up, we could always talk about that. Yeah.
And I think the sentiment is just in sympathy, if logically it makes sense, independent of any participant or employee asking, it just might make sense to, yeah.
Maybe consider dropping it. So we're matching up more closely with SJ Sarah. I love that. Yeah, thanks.
I guess, is there anything else out there that we're not aware of that we should be implementing a long time ago? I know this has been recent, all these changes. I think we probably should have done it many years ago.
Yeah, I appreciate that comment. I mean, I have been with you guys for a while, but in varying capacities. So I have a good knowledge base, but when these things come up, you know, I feel like, you know, I want to bring it to you so that you're aware of it so that we can continue to improve on the benefit for the employees for sure. So thank you.
And not to volunteer nationwide, but one of the things in the spirit of what you were saying is maybe do an annual adoption agreement, plan document review, and just say, this is what was decided when it seemed most appropriate, but this is what your other clients or our other clients are thinking about. So maybe we schedule that, I don't know, early 27, something like that. Cool, thanks.
Yeah, happy to. We have a plan doc team that would be happy to be on a call and just walk through the various plan provisions. If anything comes up, like Brenda mentioned, we'll bring it to your attention fast. And it really hasn't, I don't think it's come up. So I don't think anyone's missed out, but we do have a squeak wheel now. So then of course it rises up to your level.
Yeah, and I really like the idea of that because there have been so many provisions that have been made available to us with the Secure 2.0 that maybe didn't get brought up in discussion, or they maybe were passed over. Things like the $1,000, the IRS emergency hardship, where it's basically a self-certified distribution. The minimum or the maximum is like $1,000. Right now, your plan document is set up so that people can borrow against their deferred compensation plan, but they need to have like $2,000 or more to do it. Sometimes people have like these small emergencies, you know, their cat at the vet, whatever it is, and they just need a little bit of money. And so like there are smaller provisions like that that maybe we could revisit. And if you're like, yeah, let's add that, then that would be a good time to kind of review and have those conversations and make sure we didn't miss any of that Secure Act stuff. Because what was it, 600 different pieces, John, in that legislation? It was huge.
It's huge. Luckily, most didn't pertain to deferred comp plans. Most were ERISA provisions. We did go through Secure 2.0 many times with the committee, and we looked at optional provisions, but we're happy to bring those back. We have a one-page document with all of our optional provisions that you can elect from and add anytime.
Yeah, I think
So
that
if
would
we
be
wanna put-
helpful to add to the next meeting's agenda too, and just as part of the plan documents for us to review, that would be a good document to have for people to get their questions ready ahead of time.
Yeah, cool.
That's good.
All right. And that's pretty much my share. Thanks.
All right, Morgan Stanley, Vincent Galindo.
Right, thank you very much. Just as a way of background, I do know that there's some relatively new faces in the group. My name is Vincent Galindo. Similar to Nationwide, our firm is a vendor / outside business partner. The company I work for is technically Morgan Stanley, but the group is Fiduciary Consulting Group. and we are a fiduciary consulting firm tied to the plans here at the county. A little bit of background on me, I grew up in Woodland, outside Sacramento, and then met a woman from Oregon my first day on the job in San Francisco, and then about 25 years ago moved to Oregon. But most of my clients intentionally are down here in the Sacramento, San Francisco area, so good to be home. We are a fiduciary, meaning that every recommendation that we make has to benefit the participants in the plans, and so we take that role seriously. I do talk a little bit about the economy and the markets before I go into the plans, and it's always nice to follow John and Nationwide because they cover a lot of data points. So when I skip pages, it's not because they're unimportant. They're generally repetitive. The other part of it too is John highlighted the shape. His plans are in relatively good shape. There are a couple funds that are giving us some pause, but we'll talk about those here in a few minutes. If you can flip ahead to page 4, I do want to set the stage for what we're seeing in the economic landscape. It does seem like, sorry, probably the thickest report in front of you. Being from Portland, we're heavy tied to the paper industry, apparently. So page 4. These numbers are as of June 30th generally. I do have some updated numbers, and so as I go through, I'll update those verbally, and if you have any questions or comments or requests for predictions in the future, please let me know. On page 4, in the bottom third-ish, if you will, there are 3 relatively large numbers, not necessarily in quantity, but rather font size. These are some major economic indicators that simply set the stage for what we're seeing in the economic landscape. The bottom left is GDP, and that stands for Gross Domestic Product. Quite simply, gross domestic product is the value of goods and services produced in the United States in any given year. But that percentage sign means the year-over-year change. So we're comparing that dollar number to the second quarter of 2025. Speaking of 2025, GDP came in the fourth quarter at 0.5%. The economy was propped up by our holiday spend, which set a record. The challenge is the government was shut down at the federal level for 43 days. And so that was a big drag on our economic activity. And GDP in the last 3-month period was flat to positive. We moved into the first quarter of this year and GDP came in at 2.1%. So nice rebound. And it was in the realm of this Goldilocks economy. And they call the Goldilocks economy because it's not too hot, not too cold, rather just right. And then you'll see it dipped from the first quarter of 2.1 to 1.5%. So there has been a little bit of a slowdown in our economic activity, but still relatively healthy. And the nice thing is it's positive, so we're continuing to grow. The challenge is that middle number. Janet Yellen, who was the ex-chairwoman of the Fed, as well as Treasury Secretary, she came out recently in the last few days and said the inflation number is our biggest threat to our economic expansion. Now, to put this in context, the CPI, or Consumer Price Index, which is a measure of the cost in goods and services compared to last year, the target at the Federal Reserve is 2%. Way back in February, we were at 2.4%, so relatively close to that 2% number. And we saw Jerome Powell, chairman of the Fed at the point, was leaving, and Kevin Warsh, appointed by the administration, coming on board. Giving the new chair of the Fed, as well as that low inflationary environment, we were expecting 2, maybe even 3 interest rate decreases in 2026. And then we invaded Iran, inflationary pressures where the cost of food and energy spiked, no longer interest rate decreases expected because that inflationary number went from 2.4% to May at 4.2%, so double. And now when we take a look at the cloudy crystal ball, which is the future market, we're actually seeing an interest rate increase when the FOMC, or the Federal Open Market Committee, meets in December. So again, no longer interest rate cuts, but more interest rate hikes. And generally speaking, the bond market has recognized these inflationary pressures. Stock market, not so much. But if you flip ahead to page 5, let's talk about the Bloomberg, or the bond market, really quickly. On the bottom half of page 5, the bond market is in the second line down. It's called the U.S. fixed income, represented by the aggregate, or what we call the AG. Historically, The ag has averaged 3.5% a year over a full market cycle. And a lot of conservative bond investors like that positive, steady 3.5% growth. Take a look at the second quarter, up 0.67%, which is nice. 3.79, which is even more attractive over the 12-month. The challenge is we did see some yield spike and some weakness in the bond market. As of yesterday, the ag is flat to positive at 0.2%. So we have seen some weakness in the bond market where the 10-year yield is up over 4.5%. The 30-year is at a 19-year high. And so we are seeing some spikes in response to these inflationary pressures, not just out of the Middle East, but I don't know if you saw our, what's that? Sorry. No. Canada, the tariffs, our debt hit 40, not million, not billion, but $1 trillion. And so there is some reckoning in the bond market. But that's the mediocre news. Let's go into the stock market, where the large and small cap index continues to set record highs. About halfway down, the S&P 500 index. These are 500 large U.S. companies and typically household names. You can see for the quarter, the S&P 500 was up over 15%, bringing the one-year number to over 22%. Year to date, the S&P 500 is up 13% as of yesterday. So nice continuation of that rally. But one thing that I want to highlight here briefly, because it leads into one of the funds that's underperforming, and we understand why. The 500 companies that make up the 500 index, they're market cap weighted, meaning the bigger or smaller the company has a different impact on the performance on the way up, but also on the way down. Said another way, the top 10 companies make up 40% of the return of that index. So the S&P 490 is 60%, the S&P 10 is 40%. And so when I took a look at what we call the equal weighted index, where it's not market cap, but every company like ExxonMobil or Nike has 1/500th of a return, the equal weighted return is up 16% year to date. And that's nice to see because the concentration and the concentration risk is diminishing. So no longer is that concentration in the top 10 names, it's dispersing into the pharmaceutical and financials, less to the technology or artificial names. So just put a pin in that before we talk about the small cap index. The Russell 2000, which is the next line down, another record high, and that's not a typo for the second quarter of this year, up 21.5%, bringing the one-year number to just under 41%. Year to date, the Russell 2000 is up 22% year to date, so nice continuation of that small cap rally. And then lastly, the international markets. There are about 45 countries outside the US, and that's represented by the second line from the bottom, the ACWI or All Country World Index. The ACWI ex-US up 14.5% for the quarter, bringing the one-year number to just under 28. And year to date, the ACWI ex-US is up almost 18% year to date, with the rebound in the commodity index as well as the commodity economies. In fact, the commodity index is up 30% year to date as of yesterday. So questions, comments there?
I like that the investments are beating the indexes.
Mhm.
What stuff we have here, so great selection, guys.
Speaking of which, if you flip ahead to page 15, the broad asset allocation is that pie chart. You can see three rather large slices or colors in that pie chart. About 23% is in that conservative fixed income, represented by the navy blue. The yellow portion is about a quarter. 26% is in the target date models, and then large cap, 35%. Back to my point, these are those household names that are growing fairly quickly thanks to very, very strong earnings tied to the tech rollout or data centers, which could be in jeopardy, but more to come on that. On the bottom third, these are those funds that were giving us pause because they violated metrics in your investment policy statement. So every investment option on the menu, we mark the characteristics and screen them against the metrics in your governance document. And if there's a violation, not that we don't pay attention to the funds that are in compliance, but we do pay special attention to the ones that have violated to make sure we understand the reasons why. So the good news is, let's start with that first. The third and the fifth funds on that chart, those are no longer violating metrics, and our recommendation is to remove those from watch status. So let's get those two out of the way. MFS Midcap Growth was placed on watch a couple years ago. Our cloudy crystal ball said nothing changed. Multiples got squeezed in 2022. The performance of these high-quality companies suffered. And so given the structure of that team and their process, nothing changed, and we had predicted that they'd be in compliance. It took a couple years, but we were proved correct. And then the Invesco Gold and Special Mineral, this is that fund that invests in those precious metals that John was talking about. 2025, it was up 132%. But I digress. The reason it was placed on watch was not because of performance, it was significant manager change. For about 30 years, there was one and only one lead manager, Shan-Quan Lee. He decided to leave, and there were two new portfolio managers. Anytime there's significant management change, we pay special attention. In talking to Scott and Tarun, nothing has changed, good solid replacements, but it took a year for us to get comfortable. And so that's why those funds are removed from watch status, or at least our recommendation, and we'll get to that in the agenda item as appropriate. Now, let's get back to the not so great news. T. Rowe Price Large Cap Growth invests significantly in these fast growing companies, more tied to the communications and technology space. But given the significant run up of some of these top 10 names like Microsoft, Tesla, Apple, the valuations didn't make sense for T. Rowe Price to continue invest in those names, and they ran up in the index. And because this fund was underweight, companies like Amazon, Tesla, Google, it underperformed. The nice thing is, with some of these companies coming back to earth, the fund has actually done very well over the short term, but that's the rationale for the performance issues. It just wasn't loaded up to some of the major companies that made up the index and the run up on the way up, and they're being rewarded over the short term. There's another little bit of an issue under reasoning qualitative. The lead portfolio manager was joined by another person by the name of John Fryer 2 years ago. Tamor left the firm here a couple months ago, and that's why it's flagging for qualitative. So there is a reduction in the management team. Similar to Invesco, we're comfortable with the remaining team member, but we're not quite there yet. And so performance as well as a management change is the reason that fund's on watch. And then Vanguard International Growth. Less of a security selection. It was overweight China and the US. Weirdly enough, an international firm does have a sizable allocation to the United States. Not much, but it dragged down performance, as well as an underweight to South Korea, more closely the chip makers. And so that's the rationale for the performance issues, but no long-term concerns with Vanguard International Growth. And then lastly, and I know I'm going out of order, but I'm just trying to tell a story, Allspring Special Midcap Value. This is a fund that has violated metrics, just some security selection issues, underweight SanDisk and Western Digital. It was overweight CDW and Republic Services. And so that's why we're recommending placing that fund on watch, given the performance issue. Again, no long-term concerns there. So I'll pause for questions when it comes to that agenda item. I do want to keep rolling on page 17. The performance of the 457, this is the larger plan, obviously, is on the bottom half of page 17. The navy blue columns is the weighted return of those options that you as participants can invest in. So for the quarter, bottom left, the funds were up almost 9%. Given a weak first quarter, the year to date is only 6.5%, but the 1 year is nice, over 14%, and then 7.25% annualized over 5 years. And then speaking of the investment options on pages 18 and the top of page 19, the funds that John was talking about, here are all the investment options within the 457 plan, grouped by asset class ranked generally in risk order on that first page. So you have the more conservative fixed income funds, followed by large companies, mid-size, small, and then the international funds that invest in those 45 countries that I talked about. We have the beginning balance, any cash flow, money going in, money leaving, gains, losses, beginning balance, and then the overall allocation. That is not the performance, rather the makeup of the portfolio. And then on the bottom of 18, you have those target date funds ticking down the top of page 19. And then the DFA real estate fund and that Invesco Golden Special Mineral that I said was up over 130% in 25. Flip ahead to page 22, some impressive stats there. Not only on the top half, where you saw way back in 2022, where the plan was about 465 million. We did see an asset growth of about $215 million over the last few years, which is nice to see. But we also saw fairly impressive, second line from the bottom, the number of participant accounts. Way back in 2021, there was 6,300. It ticked up about 1,600 over the last couple of years. So that's nice to see. Very, very solid. Applause goes to Nationwide as well as staff for the increase in participant accounts. The downside, though, is when you have so many new accounts starting at potentially zero, the average account balance hasn't grown much, but that's okay because long-term, these new accounts are gonna grow to 1 million, 2 million, or 2.5 million that Brenda was talking about earlier. And so the double-edged sword is you saw not a lot of growth in participant accounts on a net basis, but just not the average account balance. Questions, comments? Okay, let's talk about the smaller but still equally important 401A plan. On page 24, you can see the navy blue performance on the bottom half. And then the investment menu on page 25 and 26. It should look the same as the 457 except for the asset size. And on the middle part, left of page 26, we just take an accounting of the forfeiture so that you as committee and staff members know exactly what the dollar amount is on that. And then on page 29, given the asset size hasn't grown as much in terms of dollars since 2022, has grown only about 18 million or about twice the amount. But what's nice to see is the average account balance on the bottom right has grown to just over $250,000, so an increase over the last few years of about $70,000 in the 401A plan. And then, unless anybody has questions on the performance, I think I've discussed that at length. But if anybody has questions or comments on the performance, there's a lot of data points on that next section. I do want to highlight just the fee structure on page 41. A recent Supreme Court did say that retirement plan fiduciaries are responsible for fees, and so this is an important component of our oversight. On page 41, this is the 457 plan. You can see the chart is made up of 3 colors. The light blue portion is the investment cost. This is what participants pay. Generally speaking, they may not know what they're paying because they're unlike a lot of other fees that we pay in our everyday life, but fees matter. And it's 31.9 basis points or 0.32%. The other 2 columns are probably a little bit more well-known because they're a line item on participant statement. But that 5.75 basis point is a combination of the navy blue portion and the orange portion. The navy blue portion is what the plan can keep for plan-related expenses. So consultant, training, legal, whatever that is, the IRS says, as long as it benefits participants, it's a legitimate plan-related expense. And then that 2.25 basis point, the orange portion, is the revenue requirement from Nationwide. So let's talk about the investment fees real quick on 42. Again, not because it's unimportant, but because fees are reasonable if not competitive, and that's our job as the consultant to come to you with any cost savings, and we have done that over the years. But on the second to right column, these are all the expenses. And I say they're a little hidden. Some would say hidden in full sight because they're fully disclosed. but the fund manager simply deducts his or her fee before reporting to you as participants the performance net of the fee. But if we take a look at the middle of page 43, the light blue row, on a $670 million plan, 1/3% or 0.319 percent is just over $2.1 million. So participants are paying that to invest in the program. And then on top of that is the next navy blue line, that 5.75 is about $400,000, and the breakup is the 2.25, we round up to 2.3, but 2.25 is about 152,000, sorry, nationwide, 152,000 to the record keeper, and then 237,000 to the plan for those legitimate plan-related expenses in the budget. And then the 401A, I'll be brief because on 45, that chart should look familiar. And then the costs on 46 tick down into the top of page 47. Participants are paying $133,000 a year to the investment managers and about $25,000 to administer the plan. And then what's nice is we just started over the last couple of years reporting the ledger on page 48. Really almost like an old school passbook savings account. Every quarter, we start with the beginning balance, simply any contributions, any growth, any distributions, and then probably most importantly, the ending balance, so that you as a committee can know what is that money going to and what the dollar amount is. And so you can see the distributions of size over the last few years to make up for those early periods where there were no distributions. So you can see as of quarter end, there was $41,943 in this account that can be used for those plan-related expenses. Questions?
One quick question.
Yes.
On the performance, are those return numbers net or gross of fees?
Net of fees, great question, yes. Truly apples to apples, so you know exactly what participants are receiving. Okay,
Do we have a balance? I thought we had a balance at one time where we had the administrative fee, what was left over. Is that the 237 here? Is that the balance, or is that just, no, that's just the annualized amount?
sorry, Fonse, where are you talking?
On page 43, you got your record keeper fees, your administrative fees, and the administrative fees goes towards our training, but I thought we had a schedule with a balance of how much we had in there.
That would be that ledger on page 48.
Okay.
So the downside of the numbers in the previous pages of that section, it's based on one snapshot in time as June 30th. And of course, we all know that markets go up and down, participants leave and add money. But the 48 is to the dollar. And yes, way back in the first quarter of 25, that account balance or excess revenue account was almost $300,000. But bills weren't being paid, hence the zero distributions. And so the committee made up for it in the second quarter. Yeah. Okay,
So do you need a motion for the actions? Or did you get there?
that's next. Well, that's a good segue. I'm not the, yeah.
Yeah, that's a great segue. So, Robert, if you want to announce the next actions requested for removal of MFS Mid-Cap Growth Fund.
Make a motion to remove MFS Mid-Cap Growth Fund and Invesco Gold Special Mineral Fund from the watch status.
This is Fonse. I'll make a motion to remove them from the watch status.
This is Sandy, I'll second.
All those in favor?
Aye.
Aye.
Motion approved. Another motion to place All Springs Special Mid-Cap Value Fund on the watch status.
I will make a motion to approve.
I'll second the motion.
All those in favor?
All those in favor?
Aye.
Aye.
Motion passes.
Thank you very much.
All right, so I will dive right on into the 401A employer contribution, which I feel like Vincent talked a lot in his report about the reporting of 401A, particularly when we talked about new accounts. I think in a couple of quarters from now, we're going to see a very different look of these numbers as we shifted from the employer contribution going to the 401A. So a couple of things just to be mindful of as we're looking out for the next ones, and I'm sure that that'll be a part of the report later, is that we're not going to see as large of growth in those plans on the 457 because half of those contributions, majority of those contributions are moving over to the 401A. It's also going to make a big shift in the 401A balances on our accounts that we currently have. So just wanting everybody to be ready for that when that comes. No shell shock there. We did pass that a motion here from this committee to allow the employer contributions to shift from the 457 deferred compensation plan to the 401A plan. Staff did work to get that completed, so big thanks to ISD and Christine and sleepless nights of payroll and to get that all set up and ready to go. Our last paycheck, which was just dated, what was our last? The 21st of August. I'm like, what month and year are we in? August 21st. That paycheck was the first one where we saw those deductions come through. People's check stubs looked a little bit different. There were some questions and curiosities about that. So we did send out correspondence letting people know that this was going to happen. It did happen on the most recent check. So that all went smoothly. But one of the reasons why I took pause to making the shift on the plan document was I wanted us to just be aware of and start really thinking about when we're making decisions, what could some of the ramifications be, right? Because I think in that process, we were getting ready to go through that process of making that shift and realized that there was a policy around there's an IRS regulation that required anybody who receives over $360,000 a year, some of our high wage earners, are capped out at a certain amount for their contributions. So anybody who receives more than that wouldn't be able to get necessarily their full contributed amount of the 3%, 5%, depending on the salary. I think that it didn't come up, I'm not going to just totally assume, but I feel like it didn't come up here because we were thinking our physicians are high earners, they're in the 401A, this shouldn't be a problem. But they have a dedicated set amount that goes into their 401A plan as opposed to a percentage. So there is some language finessing that we have to do and then bring back to get approval on some of our resolutions for those particular classifications that do have that that limit on there, that we want to make sure that they're being compensated as they are supposed to be compensated. So we have to change up some language document. We have worked with Nationwide to get some language, and we're working with our labor relations team to get that language succinct so that we ensure that our employees are receiving the compensation that they are promised, while also maintaining all the letters of the law and not having any IRS violations. So there was a lot of conversation back and forth about that. And so I just wanted to make everybody here aware of that as well. But that is being resolved and there is a resolution for it, so.
And remind me, last quarter, when we made this change to the employer contributions 401A, that was because to have a larger catch-up period? Was that the main reason?
So essentially what happens is there are caps that you can invest, right? So your contributions are limited. And so in order to be able to open up the availability for contributing more to the 457 plan for those individuals who want to contribute heavily in those plans, what was stopping them was the employer contribution into those plans. And so they were capping out sooner than what they wanted to be able to invest in. And so shifting that over to the 401A allowed that space to be opened for them to be able to make those contributions into the 457 plan at a higher amount from their payroll deductions.
Thank you.
Yep. Any other questions, comments, concerns about that?
Yeah, I just want to add, I've talked to a lot of participants about why this has happened, and it's been really well received. They appreciate not having to figure out how much to pull off the top and then put their own contributions in. It's a simpler process for them. They take the limit, divide it by 26 pay dates. It's easier for them to figure out. So, yeah, pretty good feedback.
Good.
Yeah.
It's what we were banking on. All right, so I will move on then to NAGDA conference. Some of you have your handy dandy notebooks sitting next to you with data and information. Donna in our office has prepared those for you with your flight information, hotel information, and all the information that you may need, as well as conference details. So what breakout sessions there are, which day. So that conference schedule is also listed in there. And that's really just for your awareness. One of the reasons I wanted to bring it into the agenda was because I do know that there are I'm sure Morgan Stanley, I'm sure that Nationwide probably has some events or something happening at that time that I wanted to be able to open it up for you all to be able to, whether you're inviting or promoting some of the stuff that you have going on, to be able to allow you to address the committee so that if there's certain things that you want them to really focus on, that might be helpful. So.
Yeah, I'll just say that we sent an email out to everyone who registered for our client dinner, which is the Monday night of NAGDA. If you didn't get it, let me know. You should have already received it if you registered, and we hope to see you there.
Similar but different day. Our event is the Sunday evening, not to compete with Nationwide. And so if you did not receive our invitation for the reception, please let us know. The other thing, and I think a few of you have been before, but the one nice thing about the NAGDA reception is the people and the connections you make outside of the sessions. So people are really good about networking in the hallways or whatever. So I'd encourage you to meet as many of your fellow committee members at different counties and cities across the nation.
All right, that's all I had for my.
Right. Any comments from committee members?
I'm just gonna make one. This is my first time attending a NAGDA conference, and the communication has been very well from all of the providers, from the NAGDA. I registered for their website. Everything's been really, really thorough, and Donna has done an amazing job with communicating as well.
Yeah, it's a great conference. We hope you enjoy your time. We're looking forward to seeing you. So you'll learn a lot of great sessions, a lot of great speakers. So, and first timers, I think you get to put a little sticker on your badge to let everyone know that you're a first timer.
All right. The next meeting is Thursday, November 12th at 2 p.m. and the meeting is adjourned.